On CNBC, they say stocks are up today because of good jobs report. Stocks are down today because, I don't know, Trump coughed, Stocks are up today because NVIDIA said they're going to sell more GPUs. This is all for, are there any dentists in the room? So my friend he's in private equity, he said to me, I was talking to him one day, and he goes, you know what? He goes, you remind me, this was years ago. He goes, you remind me of a friend of mine. I was talking about the markets going up and down, and he goes, stop. He goes, say, I am the dentist. And he said, I am the dentist. He said, why am I saying I'm the dentist? I was like, because you're acting like those are the people who buy the stocks and chase things up and down, and doctors, lawyers, dentists. And no offense, but I'm just saying it's retail investor who thinks that that's the way to do the market. Meanwhile, Buffett is over here saying there's something else going on, the Cathedral, which is actually an incredible thing that you can buy a piece of businesses run by the smartest, craziest people like Elon Musk, and you can buy into their companies for nothing. Like you can do it instantly, right? You can buy shares and you can be in the business. It's like, that's what Warren's doing. He's looking at businesses while everyone's in the casino. Now, here's the exciting part. Does that all make sense to you, by the way? So he calls it the Cathedral because it's actually kind of like a holy, incredible thing. Everything you're doing, you're on your computers. That's all because of capitalism. Somebody raised money through stock market possibly and created a business. This is what makes the whole thing go. This is what makes the whole thing move, and you can buy into it. Not only that, you can buy into these companies, and they have a board of directors, usually, hopefully, professional people. They're everything's overseen by the SEC. Now, that doesn't mean you don't have frauds and stuff, and that happens, stories over the years. But the SEC, and you can buy into this business. But people just look at it, and they go, what happens, most people, when do they get most excited about stocks? When they're up. And when they're up and that's when they get the most optimistic. And what happens? The stocks go down. And then when do they get the most sick of it? When stocks are down. And they say, I got to get out of this. And then what do they come to the conclusion? It's a casino. Because you're acting like a gambler. You're actually not buying businesses. You're just getting caught up. And that's the emotional aspect. And that's a big part of it. You have to realize we're all susceptible to it. I just told you I did it myself. The only thing I would say I was different was I learned the pattern. I learned the pattern of it. And Tony always says that, right? Pattern recognition. It's like you see this happen over and over again. People go crazy getting excited. Prices go up. And here's another truth that you can write down. Rising markets attract buyers. Duh. Sinking markets attract sellers. So they pile on. And then you get these dislocations that are out of control. Now, here's another way to think about it. Buffett mentioned he read this book called The Intelligent Investor, Ben Graham. It was his mentor. It was a book written in the 30s, I believe. And in the book, he said, this is how you should think about it. He goes, just think of the market, call him Mr. Market. And Mr. Market is a psychotic drunk. And every day he comes in and he offers you prices. If he feels good, he offers you high prices. If he's depressed, he offers you low prices. And you don't have to, how many of you would just listen to some psychotic drunk who's offering you stuff? You'd be like, you're an idiot, you're not well. That's the market. And so, but here's the big advantage of it. When Mr. Market is depressed and selling shares, and you are now operating in the Cathedral and you're looking at businesses, you get dislocations that are ridiculous sometimes. I will show you stocks, and I've shown stocks to my master's group that have gone up a lot. One with Dollar General, right? How much are we up on Dollar General? 55%, I think. Dollar General, how many know Dollar General? So Dollar General, what happened, like that's a boring ass company. Like how many get excited about Dollar General? No, we want to talk about NVIDIA, goddammit. NVIDIA, Palantir. We'll talk about those, by the way. But Dollar General is boring, and they had problems. What were their problems, by the way? Their customers are low income primarily. Do you know Dollar General is a dollar store? So they don't have wealthy customers, but they have a lot of them. It's a big business, actually. And they have stores all over the country. A lot of them are in rural areas that are underserved, so they're not near other stores, and so they've carved out a niche. Now, Dollar General, what happened a few years? We had inflation. Now, can Dollar General raise prices to make up all that on their low-income customers? They're already hurting. They couldn't raise the prices as much. So what happened to the business? The margins, y'all know what margins are? So their profit margin went down. And people got really negative. And then on the other thing, China, and a lot of their goods were from China. So what happened? Mr. Market got negative on Dollar General. People just thought they were screwed. Their margins are low. And what happens is eventually people stop paying attention and stocks just sit there. And I started looking at it because I read one guy who's a great value investor had bought it. And I said, why is he buying it? And if you looked at it, all I did was look back. Here's my thesis. By the way, this is what you have to have when you buy stocks. You have to have a thesis. Why are you buying it? If you can't explain it in a couple sentences, couple paragraphs, you probably shouldn't be investing in it. That's the truth. If you have to give me a 100-page explanation or a 50-minute video, how many were we watching that video that's going around R-Link, or we were watching have you guys seen this thing? It's called R-Link. No, they had a long video, right? A long video, and they were going to beat Zoom, and it was on the blockchain, which is a hot term, and you would buy a node. I don't know what a node is, but it costs 62 grand, apparently. So you buy a node, it costs 62 grand. I think it goes to the guy who's running it. And during the presentation call, the R-Link Zoom thing went down, right? It was like the screen went blank. So it was almost comical. And in the beginning of the call, the guy said, we want to introduce this guy, and he's got a $10 billion accounting business. And I stopped the recording. And I said, what? AI today, you can look anything up. I said, who's the biggest accounting firm in the world, and how much do they do in business? You know what the number is? It's like $2.5 billion. So this guy, and then they went shot to his video, and he looked like he was in the basement. I don't know if it was mom's basement or his basement. And it doesn't add up. And then they had to do a 50-minute explanation, and I couldn't even figure it out at the end. So that's not a good thesis. Now, Dollar General, here's my whole thesis on Dollar General back in January when I sent it to the master's group, is that their margins were low. I looked at their historical margins were 8 to 9%. That was their profit margin. And they were making a certain amount of money on that. And now it was 6. And how many of you are old enough to remember other periods of inflation? When I was a kid, like a baby, it was the 70s. I don't really remember. But all I knew is I grew up and I paid whatever the prices were, right? And today, what do? You pay whatever the prices are. Like, we don't like it, maybe. But you just adjust, and life goes on. So my whole thesis was not a lot of math. I just thought, eventually, it will normalize. Eventually, prices will normalize. Their customers will get used to higher prices. They'll be able to get their margins back. And you know what happened if you just did the math? If you just said, if my margins went back to 8, not even 9, which was their average, I said like 8, because that's called, what I'm doing is buying with a margin of safety in case I'm wrong. So I'm saying not the most optimistic scenario was 9, but what if it was 8? So if the margins got back to 8, the stock should be 150% higher. Why did I think that? I didn't say they were going to make more sales. I just said they were growing 6% a year. They were opening new stores. They were doing all sorts of good things. But all I said was they would normalize. And the stock went up. Miraculously, when markets fell 20%, it was going up. So people started to recognize it. And that's another lesson of the markets. Sometimes you do stuff, and the stock doesn't move. No one agrees with you. No one's agreeing with you. You bought it, you did the work, and it doesn't move. And you think, I must be wrong. But not necessarily. You might be wrong, by the way, and you might have a bad thesis. I've had thesis that I've done, and I'm always like a little Not sure. It could be a bad thesis. But it doesn't mean because the market doesn't do it. So that's a big thing. You have to think independently. So just if you come to the conclusion about Mr. Market and you understand that he's a nutcase, he's drunk, and he's going to be doing all sorts of things, it has nothing to do with the businesses. I'll give you one more example. In 2001, Amazon, you all heard of Amazon? The stock, if you look at it, it's split many times since then, so you won't see this dollar amount. But at that time, it was $100, and it went down to $6, roughly. The stock went from 100 to 6. Now, how many remember 2001? Amazon was losing money on paper. But what were they doing? They were reinvesting all their profits. And they were trying to grow this massive business. How many of you have Amazon boxes on the way to your house right now? You're lying. Yeah, come on, I know you do. So it's kind of a big business. And so actually we're going to talk to William Green later, who interviewed a guy named Nick Sleep. That's his name, Nick Sleep. He's a hedge fund manager. He had 18% year returns in a period where the market only did 6%. And he bought Amazon real early. And I asked William, what did he see in Amazon? He also bought Costco real early. He made a huge amount of money only on a couple stocks. But that'll be an interesting conversation later today. But so anyway, Amazon went down, and Jeff Bezos wrote to the employees. He said, the stock is not the company's not the stock. He goes, all our sales are up last month. All our internal metrics are better. Everything is getting better with the business. But Mr. Market just decided that he hated Amazon. Now that is incredible. I want you just to think about it. Once in a while, that's going to happen. I promise you, and I'm not saying it's happened to Amazon, because everyone knows Amazon's a great company at that point. At that period back then, it wasn't entirely clear. Because what happened the year before 2001? That was the top of the dot-com bubble. A lot of companies went out of business. But Amazon had a lot of sales, and they were growing. They just weren't profitable on paper at that time. So the stock, how many times do you need to spot something like that in your life? Like one? If you did it right. So the idea is this, that the knowledge compounds, and this is what, the two parts, the casino and the cathedral. That's in your manual right there.